Hi, I'm Kira Wheat. I'm a Senior Tax Manager at DHJJ, and I wanted to talk to you today about the new Qualified Business Income Deduction and how it may apply to you if you're a real estate investor. If you're a real estate investor, you might be wondering how the new tax law affects you and if you qualify for the new 20% deduction. The 20% deduction was created to equalize the corporate and pass-through tax rates for businesses. The new tax rate for corporate returns is 21%, whereas pass-through returns, such as partnerships and S corporations, are taxed at the individual's tax rate, which could be as high as 37%. So if you have qualified business income, you're able to take a 20% deduction against that 37% tax rate. For real estate specifically, you might have a question of whether or not that qualifies as a trade or business. It may qualify as a trade or business on its own, but sometimes there's a question as to whether the real estate business does actually qualify as a trade or business under the tax rules. So what the IRS did was create a safe harbor, which, if you meet it, allows you to qualify as a real estate investor for this 20% deduction without any additional questions asked. For a real estate business to qualify for the deduction, the following is required. You must maintain separate books and records for each rental real estate enterprise, which I'll describe later. You must perform 250 more hours of qualified rental services, and you have to maintain contemporaneous records or logs of the hours spent on the property. Those 250 hours can be hours not just of the owners individually, but of anyone that you're hiring or paying to do the services as well. The contemporaneous record requirement doesn't actually take effect until 2019, but it is recommended that you still do have some sort of support on hand for if you ever are audited by the IRS. Under the new Safe Harbor guidelines, the following types of services are qualified services: advertising to rent or lease the real estate, negotiating and executing leases, verifying information contained in tenant applications, collection of rent, daily operation, maintenance, or repair of the property, management of the real estate, purchase of materials, and supervision of employees and independent contractors. The following rental activities are not qualified rental services: financial or investment management activities, procuring property, studying and reviewing financial statements or reports on operations, planning, managing, or constructing long-term capital improvements, real estate used for personal residence, or triple net lease arrangements. So how do you meet the 250-hour test? As I mentioned before, you can combine separate properties into one enterprise to meet that test. It does need to remain consistent from year to year, so it is a decision that needs to be really considered upfront before you finalize the return for the 2018 tax year or any future tax year where you would do the grouping. For the real estate enterprise grouping, the activities need to be similar types, and you cannot group commercial and residential property into one enterprise. So you might be wondering how this coincides with the 750-hour material participation test for real estate investors. It is a separate test, and if you meet that test, you may or may not qualify for this 250-hour safe harbor, and you may qualify as a business on your own without having to worry about this safe harbor. So this is something that you should consult with your tax advisor about. But again, both of these require records to be kept of how many hours you're spending on the real estate activity. So it is a good idea either way to just track those hours, and your tax advisor should be able to give you some tools that you could use to help do that as well. If you have any questions, you can contact us at DHJJ as always. Have a great day.